Hello everyone, and welcome back to Explain the Charts. Today we're taking a look at the S&P 500, or SPY as it's known in the trading world, and we're going to analyze both the current news and the chart data to give you a complete picture of where this index might be headed. The S&P 500 has been making headlines recently due to its 6-week winning streak, which was finally broken last Friday, October 25th. This shift came on the heels of a rally in mega-cap tech stocks, which had been driving the market's upward momentum. However, rising bond yields presented a challenge for investors as the 10-year U.S. Treasury yield surged by almost 20 basis points this week. This rise is largely attributed to the strength of the U.S. economy, as indicated by recent macro data. Investors are now eagerly awaiting third-quarter earnings results, particularly from tech giants like Apple, Meta, Microsoft, and Amazon. AI monetization trends will be a key focus for these reports, and analysts anticipate a combination of steady operational performance, AI-driven revenue growth, and robust advertising signaling ongoing health and innovation in the tech sector. So, with all of that in mind, let's take a closer look at the daily chart of SPY. If we zoom out and examine the overall trend, we can see a clear upward trajectory over the past few months. This upward trend is reinforced by the recent run-up in tech stocks, as we see a significant price surge in the early part of October, pushing SPY to new highs. However, the recent pullback in price, coinciding with the news of rising bond yields, suggests potential resistance around the 585 level. This could indicate a period of consolidation or even a short-term reversal as investors adjust their portfolios based on the changing economic outlook and interest rate expectations. Let's switch gears now and take a closer look at the hourly chart to gain a better understanding of the recent price fluctuations. Here, we can see a clear downtrend in price over the past few days, starting with the breakdown from the 585 level, which we identified on the daily chart. This downtrend is particularly evident in the last couple of trading sessions, where we see a series of lower highs and lower lows, further supporting the notion of a potential short-term reversal. It's important to note that the news surrounding rising bond yields, along with the potential for a slowdown in tech earnings growth, has likely contributed to this bearish sentiment in the hourly chart. Moving forward, we need to keep an eye on the 575 level, which currently appears to be acting as a support level. If SPY manages to hold above this level, it could signal a potential rebound in price. However, a breakdown below 575 would increase the likelihood of a further decline in price, potentially pushing SPY toward the 565 level. This would align with the overall bearish sentiment in the market and the concerns regarding a potential slowdown in economic growth. While we've focused primarily on the daily and hourly charts, the 15-minute chart can provide valuable insight into the short-term market dynamics. However, due to the high volatility and short time frame, it's often better suited for scalping or short-term trades. In conclusion, SPY is currently navigating a complex market environment with both bullish and bearish factors at play. The recent pullback in price, combined with the news surrounding rising bond yields and potential tech earnings slowdown, suggests a short-term bearish bias. However, the long-term trend remains positive, supported by the strong U.S. economy and continued innovation in the tech sector. Investors should closely monitor the 575 level on the hourly chart, as a breakdown below this level would reinforce the bearish sentiment. Key price levels to watch out for include the 585 resistance level on the daily chart and the 575 support level on the hourly chart. A break above 585 would suggest a renewed bullish trend, while a break below 575 would reinforce the bearish sentiment. Ultimately, the direction of SPY will depend on the interplay of economic data, interest rate expectations, and corporate earnings reports. Stay tuned for more updates on Explain the Charts, and happy trading!